If you get hyperinflation of the money supply, there is no way there's anything deflationary going on. The business is going bust, but that's not deflation. People are going bust in a hyperinflationary environment simply because the government is taking money away from the economy by money printing. It is transferring wealth from the producers in the economy to itself. Does that describe what's going on in America? I reckon it's a pretty close fit. It's not just the Fed, it's other central banks. And the bubble is absolutely everywhere. Every stock, every corporate loan. I mean, the bond markets are in a bubble price-wise because they are completely at the wrong price. So you can see that when this goes, it will probably take the dollar with it. It'll almost certainly take the dollar with it. And it could be that we wake up one morning and find the world has just completely changed. And if you don't have any gold at that stage, you probably missed the boat.
This is Donnegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest. Alasdair Macleod is the head of research at goldmoney.com. He has a history of a career in banking as well as an analyst of all things financial and economic. He's here with us this Monday, March 22nd, 2021, to talk with us again. Thank you, Alasdair, for joining us again here on Liberty and Finance.
That's my pleasure, DK.
You can hear my security system going off in the background. That's one of our several security systems. Anyway, wanted to ask you about several topics. Many viewers have been writing in questions, and we've gathered them together for you. There's a cluster of them around interest rates and the impact on their financial lives. One of the things that is on people's mind is this specter of what's called yield curve control that the Federal Reserve has been talking about. There's been some concern that the 10-year benchmark US Treasury bond yield have been increasing, and is that going to tank the stock market? And if so, will the Fed have to, quote-unquote, come to the rescue and institute this complete control of the yield curve? And what does that actually mean, and what does it mean, how it plays out, how it affects people's lives? So could you kind of explain to us what the setup is, what's the situation we're facing, what might happen if yield curve control does get implemented, and how that will affect people?
It's an interesting one because the majority of US government financing is done, or historically has been done, I think sort of up to about 5 or 6 years. I mean, there have been issues of, 10 years and 30 years and so on and so forth, really depending as much as anything on demand. Now, that's a very different situation, say, from the UK, where the government has got debt maturing in a sort of out to 30 odd years. It feeds the pension funds, it feeds the insurance funds, and all the rest of it. So in the gilt market, I think yield control would mean a lot more than it does in the US Treasury market. Having said that, I think you find that quite a lot of people are sort of talking about yield control. Why? Because unless the Fed does control the yield by, lowering the yield at the long end, then a lot of people are in for some pretty large losses on their bonds. So I think really that's probably the source of most of the chatter. I'm not saying that the Fed won't do yield control, but I don't see them in any hurry to do it. And given, as I said, that most of US government financing is done, I think the average maturity in the US Treasury market is in the region of 4.5 to 5 years. So, this yield control story, I would just say it's a lot less relevant than it might be in other jurisdictions.
What would be you say the intention then by the Fed would be to protect the asset values of long-term bondholders primarily? I thought maybe it was to manage basically to prop up the whole system and keep it on the rails that much longer.
To manage the costs of funding for the US government. That basically is the story behind yield curve control. And that is that you lower the rate of interest going out from short-term T-bills so that the government can fund longer term at affordable yields. It's just pure manipulation, put it that way. But what I'm saying is that as far as the US government is concerned, historically, they haven't done a large portion of their funding out along the yield curve. So why are we talking about yield curve control? It doesn't really matter all that much as far as government is concerned, though admittedly, I think they did a 30-year bond a few weeks back. But these are the exception rather than the rule. This is why I think that all this talk about US, the Fed doing yield curve control is perhaps driven by people just looking at the way in which the prices of longer term debt have fallen, and they expect someone to do something about it. It's quite, this I think is a sort of normal story you get in the chatter between investment managers, pension funds, and so on and so forth, and their commentary on monetary policy.
Just so we are understanding, when you talk about the Fed managing long-term yields, do they do that directly, or would they have to do that if they wanted to pull those down? Would they have to do that simply by buying up those long-term bonds in order to force the yields down?
Yeah, the easiest way to do it is to target their quantitative easing at longer-term maturities. And that way you create a shortage. You've still got the pension funds and the insurance companies and the investment funds that require long-term maturities. And of course, they end up scrabbling for less stock at the end of the day. So that is the way to do it. Effectively, the Fed can force yields down quite significantly if they wish to do so. The fact that they haven't done so and seen no inclination to do so, I think rather fits in with what I was saying about the funding profile for the US government, which is essentially, in our terms, really quite short term. The buyers of most of the US Treasury stock are really, banks, banking institutions, sort of short-term boys, people who need T-bills, people who, or banks who are looking at, sort of maturities which don't go out on their balance sheet beyond a certain point, because otherwise they're just buying risk. They don't want volatility risk. They don't want counterparty risk. All they want is something which is secure on their balance sheet, which basically means it's got to be less than 5 years to maturity.
Now, how does this play out? Because if the Fed does try to pull down long-term rates by buying up a bunch of those bonds, those are going to accumulate. Eventually, who's going to eventually take those off their hands? Are they going to have to try to then unwind that balance sheet as they've tried in the past? And what would be the effects on those other long-term bondholders at that point? Is this just kicking the can down the road, or does this have a happy ending in any way?
Yeah, I think your phrase "kicking the can down the road" applies, though obviously there's not a direct link between kicking that can and yield curve control. But it's all part of the Fed's management of the market and the market's expectations. And of course, where this impacts, if they do yield curve control, I would expect the dollar to weaken quite materially. Because foreign ownership of US Treasuries is actually quite large. And for a large portion of this, they're less interested in the price. They're more interested in, what they're going to get in terms of interest. Because from a foreigner's point of view, if you're going to hold a foreign currency, which the dollar is obviously for them, then you're going to expect an interest rate or a rate of return on that holding, which is in excess of the risk of holding that currency. And as we have seen, there's been an awful lot of money printing over the last year. There's been a lot of money printing full stop, but last year it really, really took off. So from a foreigner's point of view, they'd be sitting there. They've got something like $27 trillion of US Treasuries portfolio investments, just financial assets. I'm not talking about ownership of factories and things like that, just financial assets. I mean, we're looking at 27 trillion. To put it in perspective, that's about 140% of US GDP. It's very overowned. And so these guys are sitting there saying, what are we getting on our dollars? And they're already seeing, governments less so, but certainly as far as business are concerned, the reason they have dollar liquidity is they expect to do business, if you like, with the United States, like sell product to them. And they're looking, in that sense, at one of the major constituents of what they do in the United States, and that's commodity prices rising. Or put another way, the purchasing power of the dollar against the commodities that a business buys in order to manufacture something. Now, whether it's manufacturing, a food product or, a sort of a white goods type product, like fridges and, and washing machines and stuff, it's immaterial. The fact is that these costs are rising in dollar terms. So what do you do? When you wake up to it, what you do basically is you reduce your dollar ownership to the lowest possible level compatible with doing business in the United States. And that tells me that there's likely to be quite a lot of selling of the dollar anyway. And all yield curve control would do is it would probably hasten that process.
You said something that made me realize there's this perverse side effect. Maybe it's not the intended side effect. If they're trying to keep rates down to reduce the borrowing costs or the burden of the U.S. debt, to hide that problem, and also to prop up the value of long-term bonds to placate major holders of those, but is a side effect that may be unintended or undesired, that by holding down those rates, you make if I'm trying to understand correctly, the attractiveness of buying of those long-term bonds by foreign holders less attractive because they're not going to get much of a yield on them. That's correct. And you could put it even more succinctly than that. You could say that you're giving these guys a price windfall. They would be silly not to take it. So that's another way of looking at it, because there are two elements to this interest rate story. The one is lower interest rates is lower return, less attractive. Lower interest rates means higher bond prices. Whoopee, I've got a profit. I can get out. So, it's not necessarily an easy thing. And I would guess that the Fed is actually very aware of these dangers. And I don't think that they're likely to enter into things like yield control very likely, because from their point of view, they already, they obviously know that they've printed an awful lot of money, though they call it QE. But you look at things like M2, and it's just shot up, unprecedented amounts. The Fed effectively is trying to save the world. They are aware of the consequences of that. And this is why, I think in around about August, they turned around and said, we're going to change our target from our inflation, we're talking price inflation, from 2% to approximately 2%. In other words, if it went over 2%, they wouldn't change their monetary policy in the expectation that actually what's happening is, as we all sort of come out of lockdown and we start spending, prices will rise, but it'll be a temporary phenomenon, because as far as the Fed is concerned, all we're seeing is an unwinding of the excess savings that are built up as a result of us all being locked down and unable to spend. Something you've been saying here is just pounding in my head of, I'm going to use the term pump and dump just because we've often talked about the metaphor of a casino, the casino of the markets, whether it's the bubble stock market or the bubble bond market or the bubble real estate market. And as long as everybody's in the casino and the slot machines are jingling and everybody's cash is flowing, there's this appearance of flushness and robustness. But meanwhile, you've got central banks taking gold out of the system and Basel III and all that sort of thing going on. It almost starts to smell of someone holding the door open long enough so that the well-informed can get a nice exit. We'll prop up the equity market long enough for everybody to get a good, nice sell and out. We'll hold open we'll prop up the bond market long enough. We'll hold the door open for you long enough, and then whoever's left in is caught in. I don't know. This is maybe just from the cheap seats, but is there any reason this might not be passing the smell test as far as being legitimate?
Well, I think the way you put it is, if I may say so, just slightly cynical.
Okay.
I mean, I think the way I would put it is that what the Fed is doing is it is ensuring that financial assets are in a bull market. Because going all the way back to Greenspan, I mean, he said, if you've got a good stock market, everybody's happy. And effectively, that's what QE does, because the way the QE is actually targeted is not so much at the banks, but more at pension funds and insurance companies. And what the Fed is doing is it buys treasuries from, say, a pension fund, and in return for that, it goes through the banking system, because the Fed doesn't have a bank account, or rather, no pension fund has a bank account with the Fed, but they have bank accounts with banks who have accounts with the Fed. So it goes through the commercial banks, as it were, and the payment just goes through, through the bank on one side, and then on the other side, it goes out to the pension fund. So the pension fund ends up with money to invest. And the whole theory of this is that the pension fund, having sold the US Treasuries, will invest in a more risky asset, say corporate debt or something like that, in order to get a better return. And of course, if you can see that that money is flowing into a mixture of, say, corporate debt and equities, then you're going to have a bull market. And that basically describes what's been going on in the market for the last, well, I mean, certainly since the great financial crisis. I mean, every time the Fed introduces QE, that's what it's doing. And the current level of QE, which is $120 billion a month, which I think is 80, originally it was 90, but 80 of US Treasuries and 40 of agency debt. That's just being fed into a mixture of corporate bonds and equities. It's simple. That's what's going on. That's where the money is going. But then, of course, there's another aspect of this, and you have to think, right, okay, I'm a pension fund. I've gone in and I bought some General Electric, let's say, or something like that. Someone sells me those General Electric. What do they do with the money? They might buy something else, but they might take it out and spend it. And so it's a combination of the wealth effect and making sure that there is sufficient money circulating in the economy to please the Fed, because the Fed thinks as long as there's money in the economy, it should be all right. And the other thing, of course, is that a lot of it depends on what the banks do, because in the current environment, the banks they've got very little balance sheet space. So, and with COVID-related loans going sour, they're not really in the business of expanding bank credit from here. If anything, they're in the business of contracting it. And we see this in the figures. So that is the deflation which everybody seems to be talking about. Oh, we're living with deflation. We're not actually. All we're seeing is that the banks are trying to reduce their leverage between their total assets and their equity. And the extent they do that, we can be absolutely certain that the Fed will just do more QE, print more money, which it does by buying bonds. And so you will never, ever get a deflation in the sense that there's not enough money in the economy. If anything, there's too much.
This keys right into a question from a viewer nicknamed P, who says, inflation or deflation, what's your opinion going forward? You've opened that, so could you give us basically the full picture of how you see that progressing?
Okay, I think the best way to explain this is to imagine that you were in Germany in 1922, 1923. The economy in real terms was tanking. Why? Because of the wealth transfer effect of accelerated money printing was impoverishing everybody. The middle classes were being wiped out. Now that is inflation. Is it deflation? I mean, we're looking at definitions here. Mm-hmm. I mean, the answer is patently it's not deflation. It is hyperinflation. And we are on the verge of hyperinflation in America. I mean, I've defined it already as hyperinflation. And we'll see under President Biden whether my definition turns out to be accurate. But as far as this difference between deflation and inflation is concerned, it's something which the macroeconomic community, the neo-Keynesians, have sort of rather invented, and they don't actually understand it because they don't understand money. This is the problem. If you get hyperinflation of the money supply, there is no way there's anything deflationary going on. The business is going bust, but that's not deflation. People are going bust in a hyperinflationary environment simply because the government is taking money away from the economy by money printing. It is transferring wealth from the producers in the economy to itself. Does that describe what's going on in America? I reckon it's a pretty close fit.
Since we're talking about the Fed managing the yield curve and managing the wealth that's appearing to be there in the equities market, the bond market, real estate market, Gambler54 says, if precious metals prices are also being actively manipulated, managed, and controlled by the bullion banks, then why would people want to invest in precious metals? In this community, it is assumed that the control is being done with full approval of the government. Not only that, but the bullion banks may be acting at the request of the government, because if PM prices went to the moon, it could imply that fiat currency is worthless, which could in turn bring down the entire Ponzi scheme. Since the government controls the printing presses, can't they just print and deploy, quote, whatever it takes to control and manage precious metal prices forever?
Well, I mean, the answer, he has a point, because we're fighting City Hall here. And the best advice that you can give anyone is don't fight City Hall. But having said that, we have a situation where there is no doubt, and I'm not talking gold here, there is no doubt that the purchasing power of fiat currencies will collapse. We don't know when. That is up to the people. It's up to the time when people, sort of give up, if you like, on fiat currencies. What we do know is that when they do that, then they will turn to metallic metal. They always have through 5,000 years of history. Furthermore, the central banks, when their fiat currencies collapse, have only one salvation, and that is to mobilize their gold reserves. So we can see what is going to happen. We don't know when. If you're in the business of regarding gold as a punt or an investment, all I can say is good luck to you. It would be quite likely that when fiat currencies collapse, you don't have any gold, you don't have any silver. Or if you do, you certainly won't have enough. Because it is at that stage that what we're looking at is the relative purchasing power of gold and silver remaining at a level. And fiat currencies, their purchasing power just completely collapsing. And then there is a sort of feedback loop, because when fiat currencies collapse, it actually enhances the purchasing power of gold and silver compared with where they would otherwise be without a collapse.
Right.
And I think I've quoted on your show before the example of, in Berlin, you could buy a 6-bedroom house in a swanky part of town for $100. And $100 at that time was a little less than 5 ounces of gold. Mm-hmm. That's what happens when you get a currency collapse. I mean, the middle classes just get wiped out, completely wiped out. Now, who in the middle classes in America or in this country, in the UK, has actually taken any preventative measures? I can tell you virtually none. I mean, we're talking gold and silver, but we are a small minority. Mm-hmm. And I wouldn't mind betting that investors who have ETFs, maybe mining stocks and all the rest of it, are playing an investment game. They're not playing a money game at all. And, they're in the business basically of buying, say, an ETF or a mine, selling dollars to buy it, with the view of realizing a profit back in dollars. Mm-hmm. Now, if we're talking about money, then the answer is you acquire gold, you acquire silver, and at some stage in the future, you will spend it. Big, big difference.
I'm glad to hear you say that, because you and I were having a little friendly chat about the use of the term money versus currency about 6 months ago, and now I'm hearing that distinction loud and clear from you. Lofty Ken has a question. Can retail demand for silver trigger the industrials into a silver FOMO, fear of missing out?
Yes, it could. And from all the information we have, it seems there's very little physical silver around. I think probably what it would require is a renewed appetite for physical silver in the form of physical ETF buying. We had a situation where the big silver ETF, SLV, said that it might have to suspend share creation or stock creation if there isn't silver available. But of course, that again puts the authorized participants in a very difficult situation because if they're going to get any SLV shares, they have to get the physical silver in order to deliver it to the custodian against which the shares are issued by the trustee. So, I know a lot of people say that SLV is crooked and all the rest of it. I don't have the evidence to say that. I mean, they do things which I think are very difficult to explain. I mean, how do you explain counting massive tonnages of physical silver into a vault and verifying it as the property of SLV? I mean, we're talking about thousands of tons. I mean, this is very big stuff. It takes a long time to do. Having said that, there are ways around it. I mean, for example, it just becomes a book entry. If the silver is already in a vault somewhere, you know what it is. It's been checked, presumably in some form of metals audit, within a reasonable time in the past. So you just make it over from one ledger into another. So I don't know if there's anything actually wrong with SLV, but I think what it will take is SLV will have to take in silver, and there are other ETFs as well, which you may be more confident in. But the other thing is that we're getting signs from places like Australia and Canada that if you turn up at say the Perth Mint and you say, have you got any silver? The answer is no. Well, they don't say that. What they say is, there's none available for you, but of course we've got silver. They're talking about delivering, I think last time I heard this was something like 40 odd tons to America if required. I don't think this is an official story, but they're certainly denying people the opportunity to take coins or small bars and things like that.
Yeah, so, we've been interviewing Australian economist John Adams a couple of times on that emerging story, and will again this week, so that'll be on later by the end of this week. And it's very interesting, a real head-scratcher. And I've heard some potentially rational explanations about, well, their unallocated accounts are in working stock that they use in their production and manufacturing process, so they can't just deliver it.
If you read the prospectus, there's a very severe limitation on unallocated ownership, and it is if it happens, it's very temporary. I think a lot of people. One of the confusions in all this is that the prospectuses are produced in English law. Now, if you read that prospectus, you will see that all sorts of caveats, we can't guarantee this, we can't guarantee that. This is standard prospectus stuff in English law. Now, when an American reads it, he thinks, hold on a minute, this gives them license to do this, do that, and all the rest of it. The way in which it works over here is that custodians, trustees, ETF issuers, the managers and so on, they're all regulated. And anyone who is regulated and breaks the rules basically faces fines, loss of reputation, everything. So in theory anyway, there is probably no overt fraud, if you like, as people would suggest. Now, having said that, I wouldn't be entirely confident of an arrangement where instead of possession of silver, I just have an entitlement to it. Because, we saw this with GLD. Back in August, GLD ended up with a sub-custodian account, I think holding something like 42 tons, or was it 49 tons, at the Bank of England. Now, clearly, The only reason that that happened was that there was a shortage of gold, and the only way in which GLD could have it delivered was to have it leased, or the authorized participant to lease it from the central banking community. And as far as the Bank of England, that's really what the management of the market. That's what that's if you like the role of central banks. They can earn money by leasing gold. Forget about the lease rates. I mean, they're negative. It doesn't matter at all. It's just an arrangement which is made for money between a central bank and an authorized participant. But when that happens, you've effectively got two owners of that gold. You have got the central bank, and because it's a lease, it is its property. Full stop. But it is also appearing, or it did. It's gone now. It has also appeared on the books of GLD as its property. No, it cannot be its property at all. So there are things in this which are ultimately dangerous if you actually want to have money outside the banking system in the form of gold and silver.
Speaking of gold, we have a question from a viewer, Jan Luce, who says, since you mentioned that the bullion banks were in trouble with their short position on gold, is the current downturn in gold prices perhaps an attempt by the banks to recover their positions?
Yes, it's exactly that. They have actually reduced their net short position from something like, I think it's $49 billion down to, I think it's around about $22 billion. So that's a massive reduction. They want to do more. Now, the interesting thing is that if you looked at the last commitment of traders figures, the normal feed, if you like, whereby the bullion banks close their shorts is they get at the same time hedge funds to close their longs. That is the way it works. And this is why, when you've got the market is oversold, there's generally a very low level of open interest. That the last figures were fascinating because it showed that from memory, I think the bullion banks found that they had a slightly increased short position. But what is more important is that the hedge funds went long of something like 11 to 12,000 contracts. So they're not playing the game. Now, this to me was a huge surprise because, if you think about how hedge funds operate, I mean, it's a pairs trade as far as they're concerned. You either sell dollar buy gold or you sell gold buy dollar. That's the way they look at it. They never take delivery, or very rarely anyway. So what are they doing when you're seeing the long bond shoot up through the roof to 1.7% yield, having been as low as 0.95% back on the 1st of February. I mean, the conditions whereby the hedge funds are now suddenly going net long of gold are extremely unusual. So I sort of start thinking about this and think, well, why would they do this? And I think there's only one answer, and that is that they are reassessing their expectations of price inflation later on this year and into next year. And they must think that at some stage, the Fed will actually be forced to raise interest rates. But until then, the Fed will be on the run, and that is good for gold. I think that's the sort of logic we're talking about.
You've covered several aspects of this next question, but maybe there's a few high points that will come to mind for you. Earl Thornburg says, it appears the entire bank system is under severe distress, and evidence of this condition is becoming apparent. You've certainly talked about that for months now. Can you list those irregularities and connect the dots for us and describe the most likely chain of events we are about to experience? I know that's a 3-day seminar down into one question, but you're due for an update to us on stresses in the banking system and what you think are some potential likely outcomes.
Difficult to know where to start. Well, let's start abroad. Let's start with the European Union. I mean, basically, the European Union is bust. The only source of money that governments have is it is printed by the ECB. If you look at the balance sheet gearing of the commercial banks in the Eurozone, they are sky high. I mean, they really are. And furthermore, if you look at the share prices of the banks in the Eurozone, they are at substantial discounts to book value. Now, if you're an investor, you sort of look at a discount to book value perhaps as an opportunity to buy shares on the cheap. But I tell you, when they are as cheap as some of the French banks, you've got to tell yourself that, hold on, what the market is telling me is not that this is not an opportunity. It is saying that effectively the share prices of these banks are option money, no more than that. Option money on their survival. Why do you have option money on someone's survival? Because you don't want to put your money up on the whole lot. So, what we're seeing is, gearing. It's not as bad as it was because markets have rallied quite strongly. And of course, the banking sector has moved with it to an extent. But I think in my last article, the way I put it is that in these strong equity markets, the banks are rather like a party of drunks just sort of raising themselves out of the gutter. I mean, and that's basically the problem. Now, going on with the Eurozone, we have lockdowns. They're not going to come out of this virus anytime soon. I mean, you could well find that lockdowns are still around. So, sort of into next winter. I mean, it really is that badly managed, the whole of the vaccine program. It is extraordinary how badly managed the whole thing is. So if you're a commercial bank and you have loans out to this business, that business, and they're all going bust, so what do? I mean, you don't expand your bank lending, and furthermore, you're already fully committed lending money to your government through the bond market. I mean, sooner or later, the whole thing is just going to fall over. And then you've got Target 2, which is the settlement system that works between the ECB and the national central banks. And if you look at the combined deficit of Italy and Spain, and factor in the ECB's relationship with them, because the ECB also has a big deficit. I think it's something like 350 billion euros. Now, to the extent that they have bought and not paid the local central bank, which is normal practice for the ECB, for government debt, then that if you like, reduces the apparent indebtedness of the country. So if you look at just taking those two, Italy and Spain, I reckon that once you factor out the ECB balance, you're looking at about 1.2 to 1.3 trillion euros of debt. Now, another aspect of this is that for local regulators with bad debts, what they like to do is to get it out of the country. So the Italians were able to reduce the non-performing loans to something like a third of what it was. Now, how did they do this? Local regulator says this bunch of loans is performing. It's just, that's what he says. Therefore, that can be used as collateral for a loan to the bank, to the commercial bank from the central bank. So the Banca d'Italia takes on all this rubbish debt and it disappears from Italy. And we're meant to think that Italy is absolutely fine. It's not. I mean, what they have been doing is just beyond description. So anyway, I'm being rather long-winded, but you gave me a hell of a task to answer the question. That is over there. In America, there is no doubt that the banks are running out of balance sheet space. And we had a bit of an argument about this with the extension of the supplementary leverage ratio, which you will recall was suspended last March. No, I think April the 1st, in fact, it was suspended. And there was some sort of belief and movement that suspension would be extended so that the banks have the balance sheet space in order to continue to buy US Treasuries and also continue if let's say they're working on behalf of a pension fund, continue to build reserves, which is the other side of the transaction, effectively at the Fed. So no balance sheet space. You've got, I mean, just look out of the window in somewhere like your multi-million apartment in Los Angeles and just see all the shipping sitting out there. The supply chains are frozen; they're not working. And this week, of course, we've also had hitting the headlines stories about microprocessors not being available for the motor industry, and so production lines are shutting down, and all the rest of it. I mean, that's just one problem on the supply chain side. And the total value of the supply chains in America is in the order of $35 to $40 trillion. The Fed is having to rescue the system from that catastrophe. And as far as the banks are concerned, the commercial banks, of course, they don't want to lend any money to anyone. I mean, they're already, I worked out the average leverage between assets and equity of your GSIB banks, there's the global systemically important banks, is 10.5 times. Now, that's high, is nowhere near what they're doing in Europe, I can tell you. But just imagine you're a banker. You've got the leverage of 10.5 times in terms of the losses that you might end up having to take on your total balance sheet compared with your equity base. Your equity base is less than a tenth of all that risk that you're carrying. So what do? You think, well, I don't want to lend anymore. If anything, I want to call in loans. So that's what happens. And that is what is going to continue to happen. And it's that environment which, of course, frightens economists, because this was something that Irving Fisher first described back, I think it was in about 1930-31, about the relationship between collapsing collateral and bank lending. And it was that wiped out some incredible number of banks in America back in the late 20s and early 30s. So they are frightened of that. Now, this is another reason that the Fed is absolutely determined that financial asset values continue in a bull market, because that takes a lot of the pressure off commercial banks. So when they turn around to a commercial bank and say, look, don't foreclose, whatever, and we can work our way through it. As far as the commercial banks are concerned, they're seeing a lot of the financial assets which they've taken in as collateral continuing to increase in value, increasing their margins on their lending. So they're not necessarily going to panic on this. But what happens if counterparty risk from abroad comes in? I mean, I've spoken about Europe. I mean, I'm convinced that's going to collapse. When I look at the share prices of the big Chinese banks, they are doing, I mean, it looks like Europe. I mean, it really does. And nobody's looking at them. But because, of course, the assumption is that you've got state-controlled banks, state-controlled and majority-owned banks, and the state will always ensure that they don't go bust. So we don't worry about that. We might worry about other things, but we don't worry about the Chinese banking system. But in terms of the market rating for the major Chinese banks, I can tell you the markets are telling us there are big problems there. We got in the UK, we have got two banks who are on the wrong end of the geopolitics between China and America, Hong Kong Shanghai Bank and Standard Chartered Bank. I mean, that sort of, if you get a banking crisis, you can see that could be a problem for the UK. I mean, I could go on.
I see what you mean, though. Where do we start?
I don't talk about the Japanese banks. We leave that. But I mean, the point is that at some stage, a rug is going to be pulled. And the way I look at the dollar and financial assets in America is, and we've discussed this before, I see it as working on exactly the same principle as John Law's Mississippi bubble back in 1720. Exactly the same principle, whereby he printed money to maintain the bubble. What's the Fed doing? It is doing exactly the same. The difference is that it's not just the Fed, it's other central banks, and the bubble is absolutely everywhere. Every stock, every corporate loan. I mean, the bond markets are in a bubble price-wise because they are completely at the wrong price. So you can see that when this goes, it will probably take the dollar with it. It'll almost certainly take the dollar with it. And it could be that we wake up one morning and find the world has just completely changed. And if you don't have any gold at that stage, you probably missed the boat.
Well, Alasdair, there's obviously so much more that we could explore together. Our time is short, though. I appreciate your visit here. And if people want to follow your writing, you give them a clue again where they can plug in?
Yeah. Goldmoney.com, research. I write an insight article, which is published in the afternoon EST on Thursday. And I do a market report on the Friday, which is published at roughly the same time.
We'll put a link to that in the description of this video. Folks, also don't let us lose track with you, so that you get every interview with Alasdair and all of our guests. Make sure you subscribe for our all free newsletter that comes out 3 times a week at libertyandfinance.com. Just go to libertyandfinance.com. Over on the left-hand side, put your name and email address. We'll get you our newsletter that comes out with all of our publications. Alasdair, as always, thanks for joining us and our viewers here on Liberty and Finance.
That was my pleasure, DK.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today. To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com. Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.